In this month's economic update, Kaplan Professional Education's Michael Pollock speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional Education's monthly economic update. I'm Michael Pollock, and today we're speaking to Chief Economist at AMP Capital, Shane Oliver. Thanks for joining us today, Shane.
My pleasure, great to be here.
So let's firstly look at the Australian economy. What do you attribute our persistently low inflation to, and what levers does the government and RBA have to give it a boost?
Well, it's odd in a way. When I started my career off, the concern was inflation was too high. Now, of course, the concern is inflation is too low. There's a bunch of things driving it. One, of course, is the fact that there's a lot of spare capacity globally. The economic recovery since the GFC has been quite slow. That in turn is leading to a lot of competition internationally, and some of that weakness is showing up in deflation. In various parts of the world we've had these worries about deflation, and some of that of course is being imported to Australia. Prices for items internationally, prices have gone down, and some of that those cheap goods come to Australia. Then of course domestically we've had an environment of sort of okay growth but not spectacular, and that of course has meant spare capacity in the labour market, which has meant very low, in fact record low wages growth. And so all of these things are combining to sort of push down the rate of inflation. And then on top of all of that, you've had an outbreak of competition domestically in areas that you may not have thought in the past. You know, for example, I went to buy a tyre, having a blowout in my car recently, flat tyre, and I found that the price of my favourite tyre had come down something like 35%, partly because of online competition. In driving those prices lower. We're seeing the competition between the supermarket chains with Aldi, Woolworths and Myer. So all of these things are combining to push the inflation rate down, and obviously that's concerning the Reserve Bank.
So what would you say is the likelihood of a further rate cut in the coming months?
I think the odds of a further rate cut are quite good, and the reason I say that is that we've still got inflation well below the Reserve Bank's target zone. The Reserve Bank hasn't changed its own forecast lately. But it's not comfortable the longer inflation lingers at these sorts of low levels. And that, of course, worries it because it fears that if it doesn't get inflation back up within a reasonable time span, then it might get entrenched, much like it has been in several other countries around the world. In other words, companies will start saying, well, I'm not going to budget for a 2.5% or 3% wage rise this year, I'll budget for a 1.5% wage rise. And that's something it doesn't want to see, because if you entrench very low inflation, the risk is that next time there's an economic downturn, you'll end up with deflation. So given all those risks, we think the Reserve Bank will cut interest rates again, probably in November. They seem to like acting in the mid month of each quarter. Reason being that's when they get the latest inflation numbers out from Australia, and that's when they also review their economic forecast. So we're looking for another rate cut in November.
To what extent would a downgrade of Australia's AAA credit rating increase funding costs for business?
Well, it's an interesting issue. In theory, if the credit rating for Australia's government is downgraded, then that should mean they'll be borrowing at a higher rate of interest. And of course, since that sets a bit of a base for everyone else, the banks will pay more when they borrow, and therefore when companies borrow, they'll probably pay a high rate of interest as well. That's the theory of it all. It depends on the circumstances, though. We've seen lots of examples of countries around the world that have been downgraded. The US, for example, in 2011, and of course more recently the UK after the Brexit vote. And yet their interest rates actually went down. So it really depends on the economic circumstances. I don't want to see a downgrade in Australia, but it's not necessarily the case that if it does occur, that it result in higher costs for companies borrowing.
So just finally on Australia, what are the positives for the economy looking out to the end of 2016?
I think the main positives for investors in Australia are the fact that the Australian economy is still growing. It hasn't had the recession that was feared almost every year. There's someone calling for a recession. It hasn't happened. The economy seems to have rebalanced. New South Wales and Victoria are doing very well. Housing, consumer spending, tourism, higher education, all those sorts of sectors doing pretty well, filling the gap left by the mining sector. So that's the first point. Second point is that over time I expect that reasonable growth will show up in better profit growth in Australia. So the last couple of years have seen profits fall. Why did they fall? Mainly because of the slump in commodity prices. Well, commodity prices look as if we've probably seen the worst. So the worst may be over for the miners. In the meantime, if you've got continued growth in the broader economy, that should help profits in industrial shares, for example. Then on top of that, you've got very low interest rates. And very low interest rates at certain points in time when everyone's focused somewhere else, worried about things going on globally, they're not investing. But when things settle down again, people make this little mental equation in their mind, well, I'm only getting 2%, 3% on my bank deposit, maybe I can do much better in the share market or in other parts of the economy in terms of investing. So my feeling is that, yes, there's always going to be volatility. There are still risks out there, but my feeling is that the Australian share market will be higher by year end and we'll have a year with reasonable returns.
Turning to the US, Shane, as the Fed continues with its steady as she goes approach, what's your view on another rate rise this year?
My view is that there will be one more rate hike in the US, but it's a sort of a loosely held view. I'd say it's about 55% probability, probably higher than what the market's allowing for. I think the latest numbers I saw from the money market in the US put the probability at just less than 40% chance of a hike in the US. But I think at the end of the day, the US economy is still growing. We have seen some softer than expected numbers so far this year, but a lot of that was because US companies have been running down their inventories, their stockpiles, and that can only go a little while before they have to replenish their stockpiles because underlying demand in the US economy is okay. So I think given the fact that the jobs market is tightening in the US with relatively low unemployment and wages growth is starting to pick up, that we will see a hike by year end. But bottom line is the Fed's going to remain very cautious and gradual. And the key lesson of this year is that the Fed is not oblivious to what's going on in the rest of the world. It's conscious that if it tightens too aggressively and if that occurs at a time when there's uncertainties globally, then those global forces could impact the US. So the Fed is conscious of what's going on globally and they're not stupid. But my base case is one hike and then continued gradual hikes as we go through next year. But it may well be the case that 2017 again, we just see one hike.
And what will be the drivers of the US economy for the remainder of the year?
The main driver in the US economy is the US consumer. The US consumer is benefiting from very low interest rates, a pickup in jobs. You can debate the quality of those jobs, but at least the numbers are going in the right direction. Wages growth slowly picking up, and confidence is sort of running around average levels. So all of these things, I think, should help consumer spending in the US. I guess there's one big unknown in the US, of course, and that's the presidential election between Donald Trump and Hillary Clinton. Time will tell how that one goes, but I think ultimately that common sense will prevail, whatever you'd find that as, but I would have my own views on that, but I think ultimately common sense will prevail in the US. And again, that should be reasonably positive for the US consumer, which in turn I think ultimately will drive a pickup in business investment. The weakness in business investment that was driven by a rundown in investment in the energy sector. Shale oil companies wound back their investment as the oil price fell. I think that's largely run its course, and stronger consumer demand in the US will ultimately feed through to stronger business investment. So those things together, but particularly the US consumer, I think will drive reasonable growth in the US.
So looking at China, what risks do increased capital outflows and the subsequent depletion of FX reserves pose for that economy?
Well, China, I guess, was under a bit of pressure. It started about a year ago when the Chinese first devalued their currency against the US dollar. So the Chinese, for a long time, had been tied to the value of the US dollar. The US dollar was going up in anticipation of the Federal Reserve and the US raising interest rates. And, of course, the Chinese currency went up with them. And they thought, well, that's a bit odd. You know, we're not thinking of tightening. If anything, we need to ease. Their economy is actually growing below potential. So they decided to break the link. They devalued. And, of course, once they devalued, that then led to concerns that there'd be more devaluation. And of course, once people start expecting a decline in your currency, you start to see capital outflows. And that led to concerns, which I think intensified early this year. So my feeling is that the worst is probably over regarding Chinese capital outflows. But you've got to be a bit careful here. If the US dollar suddenly takes off again, and that will put more downwards pressure on the value of the Chinese currency, then all that speculation about capital outflows could return. So bottom line is I think the worst is probably over, but it is an issue worth keeping an eye on.
And which sectors of the Chinese economy do you think will outperform for the remainder of 2016?
Interestingly, and this is interesting to the extent that we've heard so much about ghost cities in China. The property market is doing pretty well in China again, and while there may be these ghost cities, it's interesting to note that if you go back and look at some of them that were on the TV and elsewhere, they're now actually bustling and full of people. So a lot of that talk about ghost cities was a bit overdone, but if you look at the big cities in China, Beijing, Shanghai and what have you, they actually have a shortage of property, or the sort of property that's actually needed, and I think that as time goes by you'll see more investment in those cities. So property is a big one. You've got infrastructure spending which is continuing in China, and that to some degree is filling a bit of a gap left by private investment, which has been a bit weaker lately. Private companies have been a bit more cautious about investing, a bit unsure about the outlook. So in the short term, a lot of it does come down to housing investment and infrastructure by the government, and therefore dependent a little bit on stimulus spending by the Chinese authorities.
And finally to Europe, what do you expect to be the main economic outcomes of Brexit for the UK and the EU once or even if Article 50 is signed?
Well, there's a whole bunch of issues around Brexit. My feeling is that it's mostly negative for the UK. They'll get over it, but the adjustment process will be a bit negative because a lot of their trade is tied up with Europe. And unless they are to negotiate a deal which continues that free trade, then there will be a difficult adjustment process. In the interim, you can sort of understand companies sort of think, well, they might have located in the UK to get access to Europe. No, they don't have that access. What do? Do they relocate to Europe somewhere? So there's all sorts of issues around Brexit. My feeling is it's probably 50-50 as to whether they will ultimately leave the European Union. Recently there has been a sharp fall in confidence post the Brexit vote in the UK, so they could be heading for a recession. The Bank of England has moved to try and head that off with quite forceful monetary stimulus. So it's a bit like shooting yourself in the foot, and then fortunately a doctor was nearby, or the Bank of England was nearby to help you out. But still, there's a lot of uncertainties around all of that, and by the time it comes to leave, and that's going to take a long time because you have to invoke Article 50 of the Lisbon Treaty, which governs exits from the European Union, and then you've got a 2-year negotiating period. So there's a long way to go. And if the UK economy starts to struggle, then the British might lose their enthusiasm for it. So a bit of issues around that. The main issue regarding Brexit and its impact on us in Australia, though, is to what degree it impacts the rest of Europe. If Brexit vote triggers a domino effect of other countries across Europe seeking to leave the European Union, and hence the Eurozone and the Eurozone currency, the single currency, unravels, then that would be incredibly disruptive for the same reason that we worried about a Greek exit. And that I think would be a major problem. Now, so far so good. Immediately after the Brexit vote, the Spanish election on the Sunday after the Brexit referendum saw support swing back towards the more centrist governing party, the People's Party, and away from the Eurosceptic Podemos. And I think you'll probably see a bit more of that across Europe. The other thing to note is that Europeans tend to be in the European Union for different reasons than the UK was. The Europeans tend to see it as a source of strength, gives them force in numbers given Russia and other geopolitical threats, whereas the UK saw themselves as a power in their own right. So I think that hurdle to leave Europe for many European countries is a lot higher than it was for the UK. So they're the sorts of issues you need to keep an eye on. For me, the main ones to keep an eye on are there's an Italian Senate referendum coming up later this year, see how that goes. That will be some guidance to how successful the Eurosceptic five-star movement will be in Italy. And also keep an eye on Italian banks. There are some vulnerabilities around that. And finally, the borrowing costs that Italy and Spain in particular face. So far so good. Those borrowing costs have remained fairly low, suggesting that investors don't really worry that much about those two countries leaving the euro.
Thanks very much for your time today, Shane.
Okay, my pleasure.